Welcome back to Golden Rule Radio and welcome to 2021. Boy, we have a lot to talk about this week. And, there's plenty of people talking about politics and crazy things happening there. So we're going to kind of move away from that totally to the markets and talk about the markets because there's a lot of interesting action going on in the markets, starting with the dollar. Right at the end of the year, December 31st, the dollar touched the 1.618 extension on the very last day of the year and just pinpoint pricked it and touched it and closed just above it. And the last few days here in the markets, Monday, Tuesday, Wednesday, the dollar has been kind of bouncing off that 1.618. Essentially, it's at right about 89.5, and we'll show it here on the charts. And so that's a noteworthy event with a currency index, the dollar, and perfectly touching a fib number and showing that it's going to trade along that fib number. And is the dollar ready for a rally? We're not sure. Could be very easily ready for a rally. If it does, I'd speculate that it's going to rally into that long-term declining trend line that we've talked about for a few years on this show. And you can see how the dollar has respected this long-term downward trending trend line. And if it were to do this little rally from here, from this fib number coming up to 91, 91 and a half, wouldn't be surprising to see. I'm not sure that that would actually put downward pressure on the metals though, because the metals have been pretty strong. Here we are opening the first trading day of the year with gold. Gold pushed up above 1900, up to 1950. It's moved back today on Wednesday all the way back down to around the 1900, still holding 1900. But I think there's some interesting things that are going to be happening here in the markets in the next few weeks. And so pointing out what has happened here, where do you think we go from here, Miles?
Yeah, I'm glad you started with the dollar, Robert, because that's obviously the tug pulling the big boat. Dollar coming into your 1.618 extension and then bouncing around this 90 mark on the DXY index, which was a level we've been talking about for a while because that dates back to the previous low in the dollar back in March, April, May of 2018, before we had that last run up, which culminated at that 103 bet that you and I had going last year. Would it get back to 104? And then obviously it hasn't. So dollar breaking below 90 is big. Dollar failing back earlier this year to get to a new high is big.
That's huge.
And the amount of money that we've been spending in response to political, economic, and health concerns over the last year, I don't think either you or I expect that to diminish next year. So it's very likely, even if we see a short-term rally in the dollar, and I think you're right, I think that's very likely because of some trading reasons like the Fibonacci levels. You've got some bullish divergence possible as the price has been bouncing down here sub 90. So yeah, see something 91 and a half, maybe 92. But the real question is, where does the dollar end up finding bottom? And you stretch this chart out, I mean, you're looking at another 10 points on the dollar, and it's still not terrifyingly down. We're still substantially above, say, the 2011 bottom, if we get all the way down to 79 or 80. So the dollar sliding could be pretty dramatic, and I think you and I would agree it's expected over the next couple years.
Absolutely, which is why I think gold and silver and platinum now are starting to gain traction. Big news in the dollar, big news in platinum. Waking up Monday morning, we see platinum above 1100, pushed all the way up to 1140, which is a 4.5-year high, the highest since summer 2016. And pushed up to 1140 intraday, came back down, and now it's back up above 1100. So platinum looking like what we were talking about over the last year. It's starting to move, looking like you're either going to be on the train or it's going to leave you behind, because platinum looks like it wants to head higher. Like we said a couple weeks ago, I think platinum is about 1.5 years on the chart anyway, about 1.5 years behind gold. If you go look at the gold chart and how it bottomed, kind of had a sideways channel just straight across, just oscillating within a range, and then gold broke out 1.5 years ago, and here we are a few $100s higher. I think platinum has done the same type of thing and is just following gold, and so you want to be on the platinum train.
Sure. I mean, we've been talking about how gold's leading the charge, silver's right behind it, 6-9 months, and platinum's another 6-9 months behind that. So it's not surprising, like you're pointing out, it's not surprising to see that order kind of change. It's very likely, while it takes some time to get the momentum going in the bull market that we're clearly in precious metals now. Certainly gold has been. Silver and platinum are now starting to show that way. So it takes a while to get that momentum pushing forward, but it's very likely when you get to the other side of it and things start getting at a top, they're all going to top around the same time. The reason that we've been so aggressively encouraging things like silver and platinum is because gold already left the station, and the catch-up period is going to be much, much quicker. So, for instance, you look back at the 2008 market crash and then the bull market in metals that followed. Silver bottoms at around $7, $8 in 2008. And by 2011, middle of 2011, we're up at almost 50. And a lot of that movement happened just between August 2010 and that early, say, April 2011 when it hit highs. So you had a pretty substantial move there in a very short period of time. But that all occurred when silver broke above its previous highs, which we're not even close to yet, and finally made a move, that final last stage of a bull market up. So being that our current all-time highs are up around 50 and we're only sitting in the mid-20s, we've still got some time here before silver hits that manic phase of the market to make sure you're into the metals at that point and have your portfolio well diversified into things like platinum and things like silver as well as your gold. But you can see with the 2008 to 2011 market move, things can happen very quickly to where gold already started its trend, and then silver eventually, once it got moving, played a very quick catch-up.
Yeah, I think you bring up a good point there from the bottom in silver in the last cycle being 2008, bottoming around $8 an ounce on spot and ending up, 3 or 4 years later, touching into the nearly $50 range. 8 times 6 is 48, roughly where silver peaked. And if you want to say this past March, when silver went down to 12 times 6 would put silver peak around 72. I mean, that's just straightforward math. And so at $27, is silver cheap? Yeah, for where it's going, yes. Silver's a buy at 27. If it shows some weakness from here, that's when I'd accumulate. But I think very easily you could see silver in the $30 range within a couple weeks. If not, then I think this year it's easily in the $30 range. So buying here, it's a buy. If it pulls back and has some weakness, it's an absolute buy. It's showing the direction it wants to go along with platinum. And, they're going to catch up with what gold has already done, and gold's going to move higher as well.
Yeah, gold is definitely trying to move higher. I think there's a number of, let's say, economic, political. Yeah, there's some resistance, and I think that resistance is not always market driven. We do have some political unrest, we'll call it, this week taking place, as well as potential new president-elect stepping into office in a few weeks. And I have a very hard time believing that if it looks like the, say, stock market is going to have some type of corrective response to all of this, a downward movement in the stock market, I have a hard time believing that the Federal Reserve isn't going to step in and do everything they can to prop it up in and around January 20th. So it wouldn't surprise me at all, and I think some of this stuff does coincide with the charts, especially with the gold chart. Does not surprise me at all to see gold, although it's been moving up pretty aggressively over the last couple weeks, we're seeing it slide backwards. And I don't think it's unreasonable for me to look at the gold chart and say, hey, we could come back to some pretty solid fib levels sub 1900. What do you think?
I'd agree. Yeah. There was kind of a head fake on gold before it got hit down that day that it was down about $100. And this move higher Monday and Tuesday, this move higher into about 1950, just recovered that move down. So it really just came right back into where it was when it did that head fake. So lower numbers would not surprise me, but ultimately gold is headed higher. So our advice, buy on weakness. Acquire gold if the gold price slides down. Be acquiring in this market because the commodity sector is ready to move higher. Gold, silver, platinum are going to move higher.
Yeah, Robert, if we take back the start of this move back on March 19th, when we bottom in gold, and we get to the peak of the move in the beginning of August, you're laying your 382 fib line right at 1840. Well, what's interesting about that is if you short term started our possible seasonal bottom. We've been talking about this November, December seasonal bottom for the last couple months and how it's been pretty repetitive over the last 10 years.
And it played out perfectly, exactly what we were talking about.
Right there on November 30th. Correct. So if you start your short-term fibs at that seasonal bottom on November 30th, and let's say today we put in this short-term high with this market move down in gold that we saw today, although it is before close starting to inch back up here on Wednesday. So if you take your fibs there, guess where the 618 fib on the short term is? Right at about 1840. So I do like it when you have multiple levels on multiple time frames all pricing out at the same place. And lo and behold, you take your 200-day moving average, and where's the 200-day moving average right now? About 1835. So over the course of the next couple weeks, it's very likely we could see gold stair-step down. That moving average is going to inch back up, and everything's going to coincide right around this 1840 mark. So if I were a betting man, if we see gold take a breather from what's likely staging for the next bull market push up over the next X number of months, if we see a little bit of pullback, I'm looking at 1840 as a solid entry point for gold, probably coinciding around January 20th.
And you want to be ready to execute when it's hitting that, because look at the November 30th bottom. Didn't give us much time. So if you are in a position where you want to be adding to your metals positions or starting new ones, give us a call. We can talk to you about what makes sense. Let's jump over to the gold-silver ratio, because for the number of months, it was up around 80. And with silver outperforming, it's actually pushed down to 70 here today. And silver has clearly in the last month or so outperformed gold by about 13 or 14%, which has pushed that ratio down to 70. It still says at 70 that silver's a little bit undervalued, but not as much as it was when that ratio was 80.
Or 120. Although that was, a day or two?
Yeah, I've had a few calls in the last few weeks about the ratio because a number of our clients moved over from gold to silver in that March to April timeframe when that ratio was 100, 110, 120. You're now looking at a 70 to 1 ratio. They can pick up 30-something% more ounces of gold than they had previously in 9 months.
So, Robert, are you still recommending silver if that ratio goes to 65 or to 60?
I would, but it would make up a smaller part of the portfolio, I think. You'd agree with that, I guess?
Yeah, I would definitely think so. At least for me, when you're at 75 and 80, you're leaning pretty hard into the silver. Just like if we were at 30, we'd be leaning almost exclusively into gold. So I agree with you. I think for people who are still adding into their metals positions, that's why it's good to work with a personal advisor on your portfolio, because they can help you layer into these ratios at the right times and try to manage the overall balance of your portfolio. So it's good to hear that you're also still a silver bug at 65 like I am. Just want to make sure we're on the same page.
Yeah, and if you add up the time that you and I have spent in the metals market doing this with McIlvaney, I mean, we're pushing a good 30 years between the two of us. So if you want to work with people who have been through a few cycles, give us a call. Let's jump now to the markets that we think might be a little overvalued, U.S. equities. Is it fair to say that U.S. equities are in a bubble?
Hey, you said overvalued, and I typed DJI into my computer immediately. So I think we're on the same page.
It's fair to say that, right?
Man, that is talk about some climbing compression, right? I mean, going back to the beginning of November, the Dow doing nothing is just doing nothing slightly upwards. And that really scares me. You know that clicking noise a roller coaster makes, like right when you get to the top?
The cog.
Yeah, that cog that's just pulling you those last couple feet up at the top right before the drop. I'm not saying that's the case. And again, new administration, a lot of money getting thrown onto the table. I definitely think that they're going to do everything they can to continue to protect the plunge, so to speak. But I don't see where the value is in the equities market today.
Yeah, and I think the risk-reward ratio is way out of balance. You know, markets go down a whole lot quicker than they go up, at least the U.S. equities market does. And so as you get to these levels, yes, is there money to potentially be made? Potentially a lot of money on the upside, but the downside risk definitely outweighs the upside. So this year is a year to be cautious. You know, we started the first day of the trading year on Monday. with a down day. And somewhere in the Stock Trader's Almanac, I'm sure that it shows a high percentage of time that the first day of the trading year in the U.S. equities market is an indication of what is to come that year. Also, there's been some Elliott wave, Fibonacci numbers thrown out there where 2021 ends up being a crisis year. So things are lining up there. I'd be extremely cautious to be long equities without kind of your finger hovering over the mouse button to click get me out. The other market I think we must mention is the bond market. 10-year yield and the 30-year yield has pushed above previous levels to an 8-year high. The 10-year yield pushed over 1%, meaning bond prices are down. And 30-year yield, same type of chart, pushed up to an 8-year high. The short-term rates haven't followed. 2-year yields still kind of just dragging along the bottom, but very noteworthy to see the yields popping like they did today.
Yeah, I mean, the idea of the yield going down in the bond market has certainly been around since, say, we were toddlers back in the 80s. But to be dragging all the way down here, going off yields up around 3% in 2018, down to sub 1 in a very short period of time. At a time, going back to 2018, we were looking at these long-term bond and interest rate cycles, these 52-year cycles, and thinking, okay, it's been 20, 25, 30 years. It's very likely we're looking at bottoms. And it was possible in the yield, going back to like 2012 to 2016, 18, we might be seeing that turn around. So I'm just wondering, how far down do we go? I mean, do we have our NERP? Do we have our ZERP? Do we look at slowly going the way of Japan and other countries where we're pushing those yields even farther and farther down? Or do we have a genuine interest rate cycle where we start to see interest rates begin to climb in response to some of the other economic lending practices that took place as these interest rates have been low? So I honestly don't know. For me, it's an emperor has no clothes on thing. How long do we buy the interest rates? How long do we accept it as reality? Because naturally it isn't supposed to be. There is supposed to be some flexibility, and there are supposed to be market cycles in interest rates, and we're just not getting it. And we're not getting it not for healthy natural reasons. The reason we're not getting it has been purely manipulated. Well, that's going to do it this week, first week of 2021, Golden Rule Radio. We'll be right here along with you for the rest of 2021, so tune in every week. If you liked what you heard, hit the subscribe button, ring the bell. If you've got questions, you can head on over to our website at McIlvaney.com. Find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. Most importantly, if you'd like to discuss your personal precious metals portfolio with Robert, myself, or one of the other advisors at McIlvaney ICA, give us a call at 1-800-525-9556. Thanks for listening. Have a great week.